we are trying to explain, or we are trying to do a recap of our last class. Our last class, we explained that transfer price is the price for transactions between two divisions that belong to the same organization. For example, Dangote as a company. Dangote has different divisions. We have Dangote Cement, Dangote Transport, Dangote Food and Drink, Dangote Sugar, Dangote Salt, Dangote Flour. Now let's take Dangote Flour and Dangote Sugar. Of course, for you to manufacture your flour, you require sugar. Sugar is one of the raw materials used to manufacture flour. Now the question is, if Dangote Sugar is selling sugar to Dangote Flour, remember both divisions belong to the same organization. At what price will Dangote Sugar sell sugar to Dangote Flour? And at what price will Dangote Flour buy sugar from Dangote Sugar? This is what we call transfer price. The price at which one division sell components to another division is what we call the transfer price. Transfer price is for inter-divisional transactions. That is, transfer price is for internal sales. If this transaction will be consummated. The transfer price is the price at which divisional transactions are consummated. We explained this. We explained the condition for transfer pricing. For you to talk of transfer pricing, you must have divisional structure. One division must produce goods or service that is required by another division within the same organization. Then the division must be profit center or investment center. We also explained that both divisions must be motivated to transact with each other. We explained this. We look at the different method of transfer pricing. We have the cost-based method, where you transfer based on the cost of production. We have the market-based transfer price. We have the negotiated transfer price. We have the arbitrary transfer price. We have the transfer price based on opportunity cost. We discussed this last week. Thereafter, we solved a question on this topic. We addressed question number, I think in illustration 6 or thereabouts. We addressed that question at Abuja PSC. Tonight, hopefully we can take 2 questions, but we are rounding up this topic tonight. We shall be looking at question number, on this platform is question 1. On your study pack, it should be question number 3. Please go to your study pack. On your soft copy study pack, please refer to your study pack, illustration 3, Parts and Co. Please refer to your study pack. Illustration 3, Bats and Co. Please confirm you have this soft copy material opened. I'm not sure of the page. I think page 140, 152. I'm not sure of the page. Please, can we confirm we have opened this on your study pack?
Yes, sir, we are there.
Oh, page 132. Or page 122. Question 3, right? All right, let's go to it.
Sir.
Yeah, Jacinta. Bats and Co. is a company specializing in the manufacture and sales of bats. Each bat consists of a main unit plus a set of bat fittings. The company is split into 2 divisions, Division A and Division B. Division A manufactures the bats, while Division B manufactures sets of bat fittings. Currently, all of Division A sales are made externally. Division B, however, sells to Division A as well as to external customers. Please note, please in your exam, as you are reading the question, you are going to pay attention to information. Division A only makes external sales. Division B makes both external sales and internal sales. Both divisions are profit centers. That means both divisions are established to make profit. All right, let's continue. The following data is available for both divisions. Division A, current selling price for each bat is 450 naira. Cost per bat. Fittings from Division B. That means if Division A is buying fittings from Division B, he's going to buy at a price of 75 naira per fittings. Other materials from external suppliers, 200 naira. Labor cost, 45 naira. Annual fixed overhead cost, 7,440,000. Annual production and sales of bats, 80,000 units. Maximum annual market demand for bats, 80,000. That is the data relating to Division A. Now let's look at data relating to Division B. Division B, current external selling price per set of fittings. Remember, Division B manufactures fittings. If you are selling to external customer, Division B will sell for 80 naira. Current price for sales to Division A. If you are selling to Division A, it's going to sell at 75 naira. Cost per set of fittings. Material cost 5 naira. Labor cost 15 naira. Annual fixed overhead 4.4 million. Maximum annual production and sales of fittings, 200,000 units. That is the maximum capacity of Division B. Maximum external demand for set of fittings, 180,000 units. That means external customers are willing to buy 180,000. Maximum annual internal demand. If you are selling to a division within your company, please adjust this should be 80,000. Look at your question. Maximum annual internal demand for set of fittings should be 80,000. Not 8,000 units. Now the transfer price charged by Division B to Division A was negotiated some years ago between the previous divisional managers, who has now been replaced by new managers. Head office only allowed Division A to purchase fittings from Division B. Please underline that statement. Currently, head office has given instruction that Division A must buy fittings from Division B. That means Division B must sell fittings to Division A first. Although the new manager of Division A believes that he could obtain fittings of the same quality and appearance for 65 naira per set, if given the autonomy to purchase from outside the company. Look at that statement. It is possible to purchase fittings from external supplier at 65 naira per fitting. If you are given the freedom to purchase from external supplier, Division B makes no cost savings from supplying internally to Division A rather than selling externally. What that means is that whether you sell externally, whether Division B sell internally or externally, there will be no cost reduction. All right, requirements A. Under the current transfer pricing system, prepare a profit statement showing the profits of each of the profit for each of the divisions and for BAT and Co as a whole. Your sales and cost figure should be split into external sales and interdivisional transfers where appropriate. All right. Look at that requirement. The requirement says we should prepare a profit statement under the current transfer pricing system. Now you now ask yourself, what is the current transfer pricing system? The current transfer pricing system is that Division A must transfer fittings to Division B, or Division B must transfer fittings to Division A, and Division A must buy from Division B. That is the current transfer pricing system. And the price is 75 naira, negotiated between the managers. So on the basis of this current transfer pricing system, we are required to determine the profit statement. Any question, please? Any area will require explanation, please let's speak out. Your exam is fast approaching. You have like 5 weeks to exam. All right, if there's no question, let us go to our solution page. Requirements A. Profit statement. Under the current transfer, let me change that. Under the current transfer pricing system. Please, to make this class seamless, let's have the question opened. Let's get our calculator closer to us. For online class, the only assurance to the lecturer is that the students are participating in the class. All right, we have division A, we have division B, and we have the company as a whole. Parts and Co. Your Naira sign, assume 30 up. Although the question is tested by ACCA, that's why you have dollar sign. We are going to use Naira sign for convenience. So you are going to have your external 6, internal 6, then total 6. When you are done, we come to our cost. Remember to get your profit. Your profit is revenue less cost. So your revenue is your total sales. Then you come to your cost. Now let's go back to the question. For division A, if you refer to the question, what page? Page 122. Question number 3. Mr. Moses, you are just joining the class. Page 122. Question Question 3. All right. We are going to use this first page for our solution. Let's start with the working. Working 1. We take division A. Division A. Division A only make external sales. External sales, quantity of bats sold, 80,000 units. What is the selling price per bat, please? Look at the question and tell us.
$450.
450 naira. Please multiply. What is the external sales value?
$36
Let's
million.
make this snappy.
36 million. 36 million.
36 million. All right. We go back to page 1. 36,000. No internal sales for division A. That means total sales for division A is 36 million. Now go to division B. Remember division B. Division B must make internal sales first. Internal sales for division B. Internal sales. Division B will sell 80,000 fittings. 80,000 fittings to division A. What is the transfer price, please? At what price, please? 75 naira. Please multiply.
6 million naira, sir.
6 million.
6 million. Thank you. Now, remember that maximum capacity of division B is 200,000 units. Now, he has sold 80,000 units to division A internally. That means how many remaining? What is the remainder for external sales?
120.
That will be 120,000 fittings. That is the remaining fittings that will be sold externally. What is the price for external sales? For fittings?
$80. 80.
80 naira. Please multiply.
9,600,000.
9,600,000. All right, you can return to your page, your first page for solution. We come here, 9,600, 6,000. Total sales for division B, 15,600. We now go to the company and say, oh, external plus external, 36,000 plus 9,600. That will give us 45,600. Internal sales, like we explained, internal sales will not have any impact on the company as a whole. If division B is selling goods to division A, to division B, that is internal revenue. While to division A, that is internal cost. This will not have any impact on the company as a whole. So here you are going to put nil. I hope that point is well taken. I hope this
Yes,
point
sir.
is well taken.
Yes, sir.
Please
All
come
right.
again.
Now we are saying that if you are talking of internal sales, division B is selling items to division A. To division B, that is internal sales revenue. While to division A, that is internal purchase cost. What is revenue to one division is cost to another division. Revenue and cost will cancel out. That is why your internal sales will not affect the company as a whole. I hope that point is well taken. All right, we now go to our cost. Please note, once you have internal sales, then you must have internal purchase. Internal purchases. Division A will purchase goods from division B. Your internal sales is equal to internal purchase. That is 6,000. Again, internal purchases will not affect the group. This is revenue here. This is cost here. It will cancel out. You now come to material cost. Material cost.
Don't cry here.
We have labor cost. We have fixed overhead. Now let's go to this working. Working 2. Material cost. For division A, division A will produce 80,000 bahts. What is material cost for division A? Please check and respond. Hello, guys.
75, sir.
What is material cost? What is 75?
No, sir. I said
Is that material cost?
275. 275 naira. You know, I am adding both material from external suppliers.
It's wrong.
Okay.
It's very wrong.
Okay, sir.
The material cost is 200 naira. Why putting 75? We have taken 75 here. That is internal purchase. Is that clear, please? Your
Yes,
material cost from
Noted,
external
sir.
supplier. Please multiply. Please don't hard. This is 16 million. For division B, division B will produce 200,000 fittings. What is material cost for division B?
5 naira, sir.
5 naira, thank you. Please multiply. That will give you 1 million. Total material cost incurred by the company. Division A incurs 16,000.
That's
Division B
17,
incur 1,000.
17
Total
million.
becomes 17 million. We are done with material costs. Working 3. Let's do labor costs. We have to pay labor for doing their job. That is working 3. Labor costs for division A. Division A will produce 80,000 bars. What is labor cost per unit of bars?
45 naira, sir.
45 naira.
5 naira.
45 naira, sir.
45 naira.
So 3,600,000, sir. 3.6
Okay,
million, sir.
thank you. That becomes 3,600,000 total. Division B will produce 200,000 fittings. Oh, sorry. 200,000 fittings. What is labor cost per fittings for division B?
15 naira.
15
10
naira.
naira.
15 naira is the labor cost. Please multiply. What do you have?
3 million, sir.
3 million. Total labor cost incurred by the company. 6,600,000.
6 million.
You can now return to your calculation of material cost for division A, 16 million. For division B, 1 million. Total for the company. This is the material purchased from external suppliers. It will affect the company. 17,000. Labor cost incurred, 3,600 here. 3,000 here. Total labor cost, 6,600. Now, please check your fixed overhead cost. What is fixed overhead cost for division A?
7,440,000, 440,000.
440. For division B, 4,400,000. Total incurred by the company. Please add the two together. 11,840,000.
11,840.
Thank you, sir. You can now get your total cost. Total for division A, total for division B. We have 30 up. This will give us
35,440,000
8
total.
million. What do you have here?
Total 35,440,000.
35,440,000.
440.
Now for division A, total
33,040,000 naira. 33040, sir. 33040.
33040.
Yes,
God
sir.
bless you, sir. You can now get your profit. Is total cost. Your profit is total sales minus total cost. Total sales minus total cost. Get
Hello,
profit
sir.
for division A. Yes, sir.
Yes, I'm looking at the total for division A of 33 million and B of 8 million. Having total of 35 million is looking wrong, sir.
Now give us your own figure.
27 million for 27,040.
You are not supposed.
Sir,
Remember
I think
that.
is that, sir, I think is that 6 million naira of the, I mean, yes,
You
that's
don't need to
internal
add.
purchase.
Okay, I
So are we to add the
understand.
cannot, sir?
You don't need to add these two total together because
Okay.
this 6 million will
Okay.
not reflect here. So get your profit.
Okay, so I think that's where
36,000
difference is coming from.
minus
The
3.
first one is 2,960.
2,960.
Second one, 7,200.
7,200 total for the
And the last
company.
one,
16,160. 16,160, sir. 16,160.
is
16.
10,160. 10,160.
Seriously?
It should be 10,160.
10,160.
Yeah. Now, but if you add the profit will equal 2,960 plus 7,200. It will give you 10,160. This is the requirement A. We are done with A.
Excuse me, sir. Mr. Shiwaji, sir.
Yes, Moses.
Yeah, I joined the class a bit late, so I did not get the. I just need a little explanation on the external sales and internal sales. Just that one alone, I'll be fine, please.
Don't worry. When we get to, okay, let me try. Okay, your question. Explanation
don't
of the
know.
internal sales and external sales.
Yeah,
Is that your
internal and
question?
external. That's it, sir.
Okay. Because of that question, I will just try to read that part. It's in the question. Do you have the question open on your system?
Yeah, I have it. I even have the hard copy.
Now look at it, please. This company, Bats & Co., specializes in the manufacture and sales of bats. Each
Okay.
bat consists of a main unit plus a set of fittings. The company is split into two divisions, A and B. Division A manufactures the bats, while Division B manufactures the set of fittings, bat fittings. Currently, all Division A sales are made externally. Division B, however, sell to Division A and to Division B. They are now giving the information. For Division A, current selling price for bat, 450. Now come here. Look at Division A. Annual production and sales, 80,000 units. Maximum annual market demand for bat, 80,000. So if you want to get for Division A only sell externally.
Okay, yeah.
80,000 multiplied by 450.
450. All right.
That will give you 36 million naira.
All right,
That
sir.
is the external sales for Division A.
Okay.
Now for Division B. Division B current external selling price is 80 naira.
Okay.
Current price for sales to Division B. Division A, 75 naira. Now, go to the last aspect here. Look at it. Maximum annual production and sales of set of fittings, 200,000 units.
Okay.
Maximum annual external demand for set of fittings, 180.
Okay.
Maximum internal demand, 80,000.
Okay.
Now the question now says, look at it. It said, the transfer price charged by Division B to Division A was negotiated some years ago between the previous manager who have now been replaced by a new manager. Now look at this statement. Head office only allow division A to purchase fittings from division B. That means division A must buy fittings from division B.
Okay.
It also implies that division B must sell fittings to division A first. That means these 80,000 units, division B must sell to division A first.
Okay.
You understand? That means
Yeah, me too.
division B must sell fittings to division A first. Even external customer want to buy, you have to go and sell to division A first, because that is the condition given by your head office. It is the balance you are now going to sell to external customer. Now, if you go to that workings now, division B will sell 80,000 fittings to division A, that is internal sales, at a price of, the current price is 75 naira.
All right, sir.
80,000 fittings multiplied by 75 naira. That will give you 6 million naira.
All right,
That
sir.
is internal sales.
Okay.
Out of 200,000 units, you have sold 80,000 internally. What balance are you left with?
120.
That 120 will be sold externally
Okay.
at a price of 80 naira per fitting. 120,000 multiplied by 80. That will give you 9,600,000.
All right. Okay. Thank you, sir.
So you are done with requirements. You are done with requirement A. Now look at requirement B.
Hello, sir.
Yes, please.
Sorry to take you back. Sir, please, can you go to the solution part? I have a question there.
Okay. We should move to the solution part.
Yes, the cost. Yes, the cost. Yes, thank you, sir.
Yeah.
Okay, this one that has to do with the internal purchases that we did not take the total to the company part. Is it the one that you were explaining that is in and out, like when we noted?
Yes, good. Look at it here.
Okay.
Correct, very correct. Look at this place. Internal sales 6 million. Internal purchase 6 million.
Okay. Thank you, sir. I just wanted to confirm.
Internal sales and internal purchase. That will not affect the company.
Yes, sir. Yes, sir. Yes, sir. Thank you, sir.
I hope it's better, please.
Yes, it is. Thank
All
you,
right,
sir.
great. Requirements. Requirement B. Oliver is not online. What's happening? Alexia, maybe she has traveled. Now look at requirement B.
Head office is considering changing the transfer price.
Head office is considering changing the transfer pricing policy to ensure maximization of company's profit without demotivating either of the divisional manager. Please listen to that requirement very well. Head office is considering changing the transfer pricing policy. The company wants to change the current transfer pricing policy to ensure maximization of company's profits without demotivating either of the divisional managers. We must not demotivate anybody. Division A will be given the autonomy to buy from external supplier. That means we are changing transfer pricing policy now. Division A, go and buy your fittings from external customer, external suppliers. It is not a must to buy from Division B now. Division B should supply external customers in priority to supplying Division A. Calculate the maximum profits that could be earned or that could be earned by Bath and Co. if transfer pricing is optimized. Now we want to optimize transfer price and determine the maximum profits the company will achieve. Now to do this, please listen to this very well. Once you understand this principle now, it will stick forever. Let's go to the solution now.
Hello, sir.
All right. You are free to ask questions.
Okay. That question B, the last statement, and the Division B to supply external customers in priority to supplying to
Yeah.
A. That's in priority to Division. Can you say something about that?
Yeah. Now what it means is that Division A, you have a freedom to go and buy your fittings from external supplier. If you look at what we saw in A, Division A is being forced to buy fittings from Division B at a price of 75 naira.
Negotiated price.
Now well, good, thank you. Now the company is saying, Division B, you have the freedom to go and buy fittings from your external suppliers if you can get the fittings at a reduced price. Now,
Okay.
Division B also is giving the freedom. You have the freedom to supply external customer first. You don't need to sell to Division A first. So,
Okay.
both divisions have been given freedom now to operate. Unlike what we have in A, where they are being forced to transact business with each other. Now there is a freedom. Is that clear, sir?
Yes, sir. Nectar. Thank you, sir.
All right, let's continue. We need to look at the arrangements that will maximize profit for the company. Look at it, please. Working. No, I won't use here.
This is not where we do work.
That will be let me use this side. Yeah, let me use it. Working for arrangements that we optimize profits for Bath and Co company. VAT and Company. You are going to start with division B. Why division B? Because division B make internal sales and external sales. Division A does not make internal sales. So there's no problem with division A. It is division B that is making internal sales that we need to start with first. So you start with division B. Division B. First, what is the maximum capacity of division B? Maximum capacity of division B
200,000
is 200,000 units.
Yes, sir.
Thank you. Thank you. Now, what is the maximum external demand for division B?
External. 80.
Yes, maximum external demand.
180.
External demand.
180.
180,000. That means out of 200,000, you can sell 180,000 externally. That means division B is left with what?
20,000 units.
20,000 units. This 20,000 units is called spare capacity.
Okay.
Nobody is willing to buy this unit from division B. This is called what? Spare what? Capacity.
Capacity.
Or excess capacity.
I think excess will be fine. That time is okay.
You can either use spare or excess capacity. So what don't say it is spare. That is the remainder, extra, that you cannot sell. So don't be surprised. Examiner can use spare capacity or excess capacity.
Right.
Now, because nobody is willing to, no customers outside the company is willing to buy these systems from division B. You now put a mark. ID transfer price for spare capacity is the variable cost of manufacture. Variable cost of manufacture for division B. Now go and check division B. What is the variable cost of manufacture for manufacturing a fitting? What is material cost per unit for division B?
5.
It's 1 million, sir. Okay, sorry.
Material cost for division
5 naira, sir.
That is 5 naira.
5 naira.
Labor cost for division B, that is 15 naira. Therefore, variable cost of manufacture is 20 naira. Because nobody is willing to buy this from division B, then you are going to look at what is my variable, what is the variable cost of manufacture. We now pause. Now ask yourself, assuming you are the manager of division B, you are now selling your product at variable cost of manufacture. Are you going to be motivated or demotivated? Hello, guys.
Demotivated since there is no profit.
Thank you. Definitely, divisional manager of Division B. Manager of Division B will be demotivated. And the question says, we must not demotivate any manager. You now put a clause. You are going to put a comment here again. We are going to put a comment here. The variable cost of manufacture we demotivate manager of Division B. That means we are not going to use this call, this price.
Mm-hmm.
We now move to Division A. Division A. Assuming Division A want to buy fittings from external suppliers, what is the price it's going to pay? Look at the question and tell us.
65 naira, sir.
Thank you. Division A can buy fittings from external supplier at 65 naira. Look at it. Come here.
Although the new manager of Division A believed that he could obtain fitting of the same quality and appearance for 65 naira per
Thank
set.
you. Good, thank you. Look at it. Since Division A can buy fittings from external supplier, at 65 naira per fitting. Therefore, the following arrangements we maximize profit for the company. Let's look at the arrangements. Look at the arrangements. 1. Division A should buy 20,000 fittings from Division B at 65 naira per fitting. If you work that out, 20,000 multiplied by 65 naira. What is the value?
1.3 million.
1,300,000. Second arrangement. Remember, Division A require 80,000 fittings. Division A requires 80,000 fittings. Now, he's going to buy this 20,000 from division A, from division B. This spare capacity now. Division A will buy this remainder, 20,000 fittings from division B at 65 naira. That means out of 80,000 fittings, division A has gotten 20,000 fittings from division B. Now come here. Division A, we buy the remaining fittings in bracket 60,000 units. That means 80 minus 20 from external supplier at 65 naira per fittings. That will give us 60,000 multiplied by 65. What is the value, please?
3 million.
3 million
900,000.
900,000. The third arrangement, division B, we sell 180,000 fittings to external customer. What is the selling price for division B, external customer?
80 naira.
Thank you, at 80 naira per fitting. What would that give us?
It was 14 million 400,000.
That becomes 180 multiplied by
80 naira.
80 naira. That will give us
14
million 400. We can prepare the profit statement now. Remember, division A, we make external sales. You can prepare your profit statement now. With this arrangement, we can prepare the profit statement now. Let's use this place.
We've left space at the other side now. After that profit.
Will it take it? I'm looking at, will that place take it? That's my fear.
Okay.
I'm looking at, okay, let's look at it. I'll take this off.
I know you to be a good manager of space.
We have requirement B, profit statements based on new transfer price. You have division A, division B, then VAT and co. You have your naira sign with 30, naira sign with 30, naira sign with 30. We have our external sales, our internal sales. Division A, we still make external sales 100%. 80,000 baht sold externally at a price of 450. That will still give you 36 million. Division A does not make internal sales. Total sales for division A, 36,000. You close this. Division B, we sell 180,000 externally at a price of 80 naira. That will give you 14,400,000. The balance of 20,000 units will be sold internally at a price of 65 naira. That will give you 1.3 million. Total sales value for division B,
15,700.
700. Now go to the company. External plus external. That will give us 5,400. Internal sales will not affect the company. Total sales here, 5,400. You now come to your cost. Please always remember, once you have internal sales, you must have internal purchase.
Purchase.
Is that clear, please?
Yeah.
Internal purchases. To division B, this is internal sales. To division A, internal purchases, 1.3 million. This will not affect the company. We also have purchases from external customer. Purchases from external supplier. External supplier. That is your 3.9 million. Division A, we purchase 60,000 fittings from external supplier at the price of 65 naira.
Yes.
External supplier will affect, this money we go is leaving the company. It will affect the company as a whole because we are purchasing fittings from external supplier. You now come here, your material cost. This will not change. For division A, material cost is 16,000. For division B, this is 1,000. Total 17,000. Labor cost will also come. Labor cost, 3.6 million for division A, 3 million for division B, total 6.6 million. Then fixed overhead. Fixed overhead. This is 7,440, 4,400,000. 11,840. This is what I'm trying to avoid. You can now get total cost for division A, total cost for division B, total cost for the company as a whole. This will give us 8,400,000. These are total costs.
Yes, sir. 32,240.
32,240.
240.
How much?
32,240.
240.
240.
39,
Total cost, please, sum.
39,340. 39,340.
39.
340.
3.
What?
Is this correct?
Yes, sir.
Yes,
I'm
sir.
not sure.
I have a doubt there.
Is this correct? Please reconfirm.
I have 145,900 there.
45.
145. 145,900.
It can't be 145. Oh. 39 plus 17 plus
6,600.
Please let me confirm.
My sir, is that 118,400?
11
See,
840. No, it should be 840.
11,840.
Okay.
It's an error.
That is correct. It's 39,340.
39,340.
Oh, it's 340. I bien,
Yes, sir.
39,340. You can now get your profits. Total sales less total cost. Profit. This will give you
3,750.
3,760.
7,300.
11.
How much here?
3,760.
3,000.
760.
760.
And the last one will give you 1160 naira.
11,000.
60 naira.
060. If you look at it now, the company's profit has increased. Even if you compare, look at, okay, let me go up small. Oh no, it's too much. Let's compare the profit for A and B.
Division B increased by 100.
Look at it. For division A, based on the new transfer pricing arrangement, the profit has increased to 3,760,000. For division B, based on the new arrangement, the profit has increased to 7,300,000. For the company as a whole, the profit has increased to 11,060,000. That means the new arrangement is better. This is what we call, you must determine a transfer price that will optimize the profit of the company as a whole without demotivating either of the divisional managers. This arrangement is the best arrangement for the company. All right, we are done with requirement B. Any question? Any comments? Or any observation?
Sir, please kindly go back to the last page of the workings, please. I just want to say something.
All right. The last arrangement, I'm coming, please. I'm trying to clean my hand. The last aspect of our working. In exam, you are going to define the arrangement. Yeah. Which aspect do you want now? Started from here up to this side.
Yeah. Okay. Fine.
Are you fine?
No, please still go. Go up. Go. Just keep going. Number 3.
This is the arrangement. This is the
Okay.
arrangement that is guiding our computation.
Okay. Okay, I'm fine, sir. Thank you.
All right. We can return to requirement C. Requirement C is theory, no calculation there now. Let's look at it. Requirement C. Discuss the issue of encouraging divisional managers to take decision in the interest of the company as a whole, where transfer price is used. Provide a recent recommendation of a policy VAT and Co should adopt. The question says discuss why. Why should divisional managers take decision in the interest of the company as a whole? You know, it's very possible that you have your corporate head office in Lagos, like Dangote. Apology, I'm always using Dangote because that comes very closer to us. Dangote corporate head office is in Lagos, but Dangote Cement is located in Kogi State. That division is in Kogi State. The production is done in Kogi State. The divisional manager is based in Kogi State. It's very possible that that manager in Kogi can be taking decision that is not in the best interest of the company, because the head office cannot see what the manager is doing. Now the question is, we should discuss why the manager should take decision in the best interest of the company. If you have to explain this, you are going to start by saying that divisional managers should always act in the best interest of the corporate head office of the company as a whole. Divisional managers should always act in the best interest of the company as a whole. This is to guarantee, or this is to promote goal alignment. This is to promote goal alignment. That is, the objective of the division must be in line with the objective of the corporate head office. If the divisional manager fails to act in the best interest of the company, this could lead to suboptimality. Where the divisional managers fail to act in the best interest of the company, this could lead to suboptimality. And this could lead to reduction in the company's profit. For example, the negotiated transfer price of 75 naira and the condition and the current condition, the current transfer pricing system is not in the best interest of the company. Division A should not be forced to buy from Division B. Division B should not be forced to sell to Division A. To optimize profits, Division A should buy from external suppliers. While Division B should also sell to external suppliers first. The arrangement that will optimize profits is that arrangement that we have stated in your question, in the solution, that working for. That is the arrangement the company will adopt. When you get the video, please try to make out the explanation. Let us take one more question and round up this topic. We have done this. Now go to question. I'm not sure the maybe page 123 or so. Garki PSC.
Yes, what, sir, what's the pay, sir?
I should ask you, should you have the material with you?
I'm not
Page
seeing Gaki.
121.
Page 121.
Thank you.
Question what, please?
Illustration 2.
Yes, sir.
I check
Illustration.
illustration 2, page 121. Illustration 2, page 121. Page 121. Question 2. All right, please, let's follow this question together. As much as possible, follow the question and let's go along. At times, some students, they will just be in the class, but they are not following the question. That might be challenging. All right. Gaki PSC is a holding company with 4 divisions, including Alba and Beta divisions. Alba division produces a component that is sold externally and can also transfer to other divisions within the group. Look at that sentence. This company has 4 divisions, including Alba and Beta divisions. Alba division produces a component that is sold externally and can also transfer to other divisions within the group. Beta division uses this component from Alba division as a raw material for its final product. Beta division uses the components from Alba division as a raw material for its own final product. The division can also obtain the component from external suppliers. The components, when obtained from ABA division, undergoes further processing at a cost of 4 naira 50 kobo per unit before it is sold to the external market. Look at that sentence very well. If ABA division buys components from, if beta division obtain components from ABA division, this component will undergo further processing at a cost of 4 naira 50 kobo per unit before it is sold to the external market. The board of directors, in order to implement a new appraisal review, has set up a performance scheme for the divisional managers. A performance target for the next financial year has been set. And the following budgeted information related to the two divisions has been prepared. Let's go to it.
Roll up, please.
We have Alpha division and Beta division. Maximum production and sales capacity for division ABA is 900,000 units. Sales to external customer for ABA division is 700,000 units. If you look at that, if sales to external is 700,000 units, that means sales to internal should be 200,000 units. 900 minus 700. The balance is 200,000 units. That will be sold internally. Selling price for division ABA is 6 naira 80 kobo. Variable cost per unit 4 naira 90 kobo. External, divisional fees cost 160, 140. Capital employed 4 million, 3 million respectively. Residual income 700, 500 respectively. Divisional cost of capital 12%, 10% respectively. Beta division has asked ABA division to quote a transfer price for units of the components. Requirements A. Calculate the transfer price per unit, which ABA division should quote to Beta division in order that its budgeted residual income target will be achieved. Now, if you look at this question, we need to calculate a transfer price. But the transfer price must give us budgeted residual income. That budgeted residual income is for division ABA is 700,000 naira. The company is saying that you can charge any transfer price, but the transfer price must give you a target residual income of 700,000. Division A can charge any transfer price in life, but it must achieve a target residual income of 700,000 naira. How do we go about this? You have been given a condition to be fulfilled. So what is the price that will give us, that will give division A? A target residual income of 700,000 naira. If you are faced with a question of this nature, this is how to approach it, please. Requirements A. Calculation of transfer price for division A. That transfer price must give us a target. You start with the target. What is the target residual income?
700,000.
The amount is
700,000.
700,000. Now let me ask the class, what is the formula for residual income? Can we remember the formula for residual income?
Yes, sir.
Your profits
Before
operating profit minus capital employed, Abi,
times
multiplied by the cost of capital. Is that not? Great.
Yes. Sir.
Thank you. That means we are told that for division A, residual income is 700,000. We don't know the profit. Minus, what is the capital employed for division A? 4 million. Is that not?
Yes, sir.
Cost of capital for division A?
4 million naira, sir.
12%.
Okay, 12%, sorry.
Can we derive the profit? You can come to 700 is equal to profit. Work this out. 12% of formula will give you what?
480,000, sir.
80,000.
480,000.
480,000. That means you can get your profit. Profit is equal to 700 plus 480. Is that not, please?
Yes, sir. 1,180,000.
1,180,000.
180,000. Yes, sir.
That is the profit that must be achieved. I can return here to say, I'll just come here, add imputed interest charge. Please note, cost of capital multiplied by the capital employed is known as imputed interest charges. That is your 480. If you add these two together, the profit is 1,180,000. That is the profit that must be achieved if we are to meet our residual income targets. Once you get the profit, add your fixed cost, divisional fixed cost, divisional fixed cost. What is the fixed cost for division ABA? Check the question. 160. Please, fixed cost plus profit will give you what? Accountants. Your fixed cost plus profit will give you what?
To give us contribution.
Contribution. You are trying to do a work back now. The contribution is, please add 1,340,000. When you have gotten that, add your variable cost. This company will produce 900,000 units of components. Variable cost per unit is 4 naira 90 kobo. 900,000 multiplied by 4 naira 90 kobo. What is total variable cost, please?
4,410,000.
4,410,000. Variable cost plus contribution will give you what?
Yes.
That is your sales value.
5,750,000.
Total sales value. Total sales value is 5,750,000. Remember, sales is divided into two: external sales and internal sales. Total sales is 5,750,000. Now let's get external sales for division ABA. External sales. If you look at the question, maximum external sales is 700,000 units. Is that not, please?
Yes, sir.
What is the selling price for division ABA?
6.8.
6.8. Please get your external sales value.
4,760,000.
4,760,000. If total sales is 5,750,000 and external sales is 4,750,000, what is internal sales?
990.
Our internal sales is internal sales. That is, we are going to sell 200,000 internally. We don't know the price yet, but it must give us 990,000. We don't know the price yet. What is the price per unit of internal sales?
4 naira 95 kobo.
Thank you. Look at it. Price per internal sales is equal to 990 divided by 20,000 units. 4 naira 95 kobo. If you put that here now, 4 naira, that is internal transfer. That is the transfer price that will give us residual income of 700,000.
Ishwaju,
Yes, sir.
please, before you go further again, let us just go through the question again and then just at least go back to from This one
Transfer
is
price. I'll go to a transfer price for ABBA division is equal to 4 naira 95 kobo. Okay. Based on request, we should go through the question again. Is that your request, sir?
Yes, sir. Yes, sir.
Let's go to the question again. Now listen to it. Somebody can read.
Let
Any
me read.
volunteer can read.
Let me read, sir. Gaki PLC is a holding company with 4 divisions,
Okay.
including ABBA and EBU. ABBA division produces a component that it sells externally and can also transfer to other divisions within the group. Beta
Good.
division uses the component from ABBA division as a raw material for its final product. The division can also obtain the component from external suppliers. The component, when obtained from ABBA division, undergoes further processing at a cost of 450 kobo per unit before it is sold to the external market. The board of directors, in order to implement new appraisal review, has set up a performance scheme for the divisional manager. A performance target for the next financial year has been set, and the following budgeted information relating to the 2 divisions has been
Look at
prepared.
it.
Okay.
Look at it, please. ABBA division, maximum production and sales, 900,000 units.
Yes, sir.
Sales to external customer, 700,000 units. That means if you are out of 900, you sell 700 externally. The balance will go where?
Better.
The balance will be sold internally.
That's better.
What is the balance now?
200.
Selling price for division ABBA, 680 kobo. Variable cost for division ABBA, 190 kobo. Divisional fees cost, 160. Capital employed for ABBA, 4 million. Residual income target, 700. Divisional cost of capital, 12%. Requirement says calculate the transfer price per unit, which ABBA division should quote to beta division in order that its budgeted residual income targets will be achieved. Any area of concern I need to re-explain?
We are fine, sir.
All right, look at requirement B. Calculate the selling price per unit, which beta division should quote to external markets in order that its budgeted residual income targets will be achieved based on the transfer price quotation. State clearly any assumption. State clearly your assumptions. We are going to take the same approach. What is the target residual income for beta division?
That is
500,000. You can come here, do your working. You can use here. Solution to requirement B. Calculate selling price for beta division. Because we want to achieve target residual income. So you are going to start with target residual income of beta division. That is equal to 500,000. Then add, we call it imputed interest charge. Now go and check. What is the capital employed by beta division? 3 million naira. What is the cost of capital for beta division? 10%. Compute the imputed interest charge.
300,000.
300,000. That will give you the profit for beta division. 800,000. Then add the fixed cost. Divisional fees cost. That is 140,000 for division beta. Profit plus fees cost. That will give you contribution.
That's 940.
940. Then base of beta division. For beta division, you are going to have two costs. Beta division will purchase components from division ABA. Remember, Abi?
Yeah.
Components from ABA division. We are going to purchase 200,000 components at a price of 4.95 naira. That will give us 990. That is the internal purchase cost. This component will undergo further processing. Further processing costs. Further processing costs. We are going to process 200,000 components at a cost of 4.50 naira. Please multiply. That should give us how much? 900,000.
Yes, sir. Now.
You can now sum up contribution plus the two variable costs. That will give us our face value.
2,830,000.
Face value. How much?
2,835,000.
2,830,000, Abi?
It's 30, sorry, yes.
30.
That is the sales value for beta division. Remember, beta only make external sales. And is going to sell 200,000 units. The units obtained from division is going to buy 200,000 components from division ABA. This component will be further processed and sold to external customer. So quantity sold, quantity sold, 200,000 units. What is selling price per unit?
14 naira 15 kobo.
Thank you. Selling price per unit is equal to 2,830,000 divided by 200,000 units. That will give you 14 naira 0.15. That is the selling price that must be quoted by Peter Division in order to achieve his target residual income. The examiner says, okay, look at it. Explain why the transfer price calculated in A may lead to suboptimal decision making. From the viewpoint of Garki PLC taken as a whole, why would this price lead to suboptimal decision making? Look at the explanation. We are charging a price of transfer price of 4.95 naira. Why the external selling price is 6.90 naira? Look at the explanation, please. The transfer price to Peter Division will be suboptimal to the company as a whole. Since 6.80 naira is the price to external customer, while 4.95 naira is the price to the division, necessitating a loss of 1.85 naira per unit. If you compare 6.80 naira minus 4.95 naira, that will give you 1.85 naira. What we are saying is, customer is buying outside at 6.80 naira, and you are selling internally as 4.95 naira. That means for every unit transfer internally, the company is losing 1.85 naira. The suboptimal decision making also can be due to the buying division recognizing the fixed cost of 160 naira, 160,000 naira. What that means is that ordinarily, fixed cost should not be included in decision making.
Yeah.
By introducing the fixed cost, that could lead to suboptimal decision making because this fixed cost will be incurred whether we produce or we don't produce. Ordinarily, we are not supposed to consider fixed costs. The transfer should have been done at variable cost. So that will be explanation. May God give us a better understanding.
Thank you, sir. Amen.
The last aspect of this question: in what circumstances would a negotiated transfer price be used instead of market-based transfer price? So, what is negotiated transfer price? Under what circumstances do you think it is better to use negotiated transfer price? Yes, any comments?
The negotiated transfer price is the price that is that a product of agreement between the manager and the profit maker.
I can hardly hear you.
I was not saying anything.
Oh, okay. All right, please note. The response is also anyway. Look at the response. A negotiated transfer price is a price agreement between the managers of the profit center. That means it's a product of agreements between divisional managers. Managers are given the freedom to agree on transfer price. Negotiated transfer price are appropriate when there is an imperfect market for the goods and services that are bought and sold between divisions. It is most appropriate to use negotiated transfer price if you have an imperfect market situation. So what is imperfect market situation? Can we recall where
the division can set
a company has, okay, anybody in perfect market situation?
imperfect market situation is a situation whereby the selling division can sell to both internal and external.
Can sell externally, It's not complete too.
Aṣáájú,
Yes.
brain yẹn ti ń shut down, brain yẹn ti ń shut down. Ó ti rẹ̀ ẹ́.
Imperfect market situation is where a division has external sales for its products. However, cannot sell all the output fully at the external market. That will give rise to spare capacity. Like this question we solve now. Like this question now. Maximum capacity is 7 miles. Our division maximum capacity is 900,000 units. External sales 700,000 units. Now this company has an imperfect market. It can produce 900,000 units, but can only sell 700,000 units to external customer at a price of 6 naira 80. 900 minus 700, we give us 200,000. That 200,000 is referred to as spare capacity. In this case, you have an imperfect market situation. That 200,000 units can be transferred at a negotiated price. The price negotiated between Beta division and Alpha division. The two of them will agree on the price for the spare capacity. So negotiated transfer price is appropriate where there is an imperfect market situation. May God give us a better understanding.
Amen, sir.
Market-based transfer price is based on the existence of external markets. Plus sum of transfer pricing. When it comes to determining transfer price, that will be paid between divisions of the same company. It uses the normal market rates that will be paid if the goods were bought in the open market. All right, we are done with the question. And by extension, we are done with the topic. When we meet next week by God's grace, we are left with two topics. We have to treat budgets and variance. So next week, by God's mercy, we are going to enter budgeting. Then we are going to round up this class with variance analysis. We shall be closing the class tonight on this note. Please, you are encouraged to start looking at your book. You have just like 5 weeks to exam. May God give us a better understanding. Any question? We call it good night.
Not actually a question, but observation, sir.
All right.
Please.
All right, please go ahead.
Quickly make this video available on your site as early as possible. Because you have to go.
All right. By standard of the school, the video should be ready tomorrow. That is the standard that is communicated to us. Of course, we have a central recording. It's not even done by the lecturer anyway. We have a staff that is dedicated to do this video. So once I finish the lecture, it's supposed to record, prepare, and make it available. But you should get it tomorrow. All right, good night.
Good night. Thank you, sir.
Good night, sir.